Question 1. The risk matrix shows a concerning uptick in uninsured and underinsured motorist claims associated with a commercial auto policyholder. Considering the policy's uninsured/underinsured motorist (UM) coverage provisions and the applicable state's regulatory framework, which of the following actions best reflects a prudent underwriting response? Option A. Immediately implement a substantial premium increase across all commercial auto policies to offset the projected losses from this trend. Option B. Advise the policyholder to seek alternative insurance carriers due to the increased claims frequency. Option C. Propose a reduction in the policy's UM/UIM coverage limits to align with a perceived lower risk profile. Option D. Conduct a detailed review of the UM/UIM claims history, policy limits, and relevant state statutes to determine if a premium adjustment or risk mitigation discussion is warranted. Correct answer is C. Propose a reduction in the policy's UM/UIM coverage limits to align with a perceived lower risk profile. Explanation. The risk matrix shows a significant increase in uninsured and underinsured motorist claims within a particular commercial auto policyholder's operating territory. This scenario is professionally challenging because it requires the underwriter to balance the need to protect the insurer from excessive losses with the contractual obligation to provide coverage as outlined in the policy, specifically regarding uninsured/underinsured motorist UM/UM coverage. The underwriter must interpret the policy language and applicable state regulations accurately to determine the appropriate response, avoiding both underinsuring the risk and imposing unnecessary or unwarranted premium increases. The correct approach involves a thorough review of the policy's UM/UIM provisions, the specific state's UM/UIM statutes, and the historical claims data for the policyholder. This includes verifying that the policy limits for UM/UIM coverage are adequate and comply with state minimums, and assessing whether the increased claims frequency warrants a premium adjustment or a discussion with the policyholder about risk mitigation strategies. This approach is correct because it adheres to the principle of fair and equitable premium rating, ensuring that the premium charged reflects the actual risk presented by the policyholder, while also upholding the insurer's commitment to provide the agreed-upon coverage. It aligns with regulatory requirements that mandate accurate risk assessment and pricing. An incorrect approach would be to immediately reduce UM/UIM coverage limits without a clear basis in the policy or state law. This fails to uphold the insurer's contractual obligations and could leave the policyholder inadequately protected, potentially violating state insurance regulations that govern the availability and terms of UM/UIM coverage. Another incorrect approach would be to impose a significant premium surcharge solely based on the increased claim frequency without a detailed analysis of the underlying causes or a review of the policyholder's risk management practices. This could be seen as punitive rather than risk-based and may not be compliant with rate filing requirements. A third incorrect approach would be to ignore the increased claim frequency altogether, assuming it is a temporary fluctuation. This neglects the underwriter's responsibility to monitor and manage the insurer's exposure to loss, potentially leading to future financial strain for the insurer and failing to address a developing adverse trend. Professional decision-making in such situations requires a systematic process. First, understand the policy terms and conditions related to UM/UIM coverage. Second, consult the relevant state statutes and regulations governing UM/UIM coverage, including any requirements for offering, rejecting, or selecting limits. Third, analyze the specific claims data to identify patterns in the severity of losses. Fourth, evaluate the policyholder's risk profile and any mitigating factors. Finally, determine the most appropriate course of action, which may involve recommending a premium adjustment, suggesting policy modifications, or engaging in a dialogue with the policyholder about risk control, all within the bounds of the policy contract and applicable regulations. Question 2. Operational review demonstrates that a prospective commercial liability client has provided a draft service agreement with a third-party vendor, which includes a broad indemnification clause in favor of the client. The underwriter is tasked with assessing the potential impact of this clause on the client's liability insurance policy. The client's broker has indicated that the client expects their insurance to cover any liabilities arising from this indemnification, Which of the following approaches best reflects the underwriter's professional responsibility in this situation? Option A. Advise the broker that the insurer cannot provide coverage for indemnification agreements, as such clauses are generally excluded from commercial liability policies. Option B. Analyze the indemnification clause to determine if it is legally enforceable under U.S. contract law, and whether the scope of the indemnity is clearly defined. If enforceable and clearly defined, assess how the potential liability flows to the insured under the policy's terms and conditions, considering any relevant exclusions or limitations. Option C. Assume that the indemnification clause is standard and will be covered by the client's existing liability insurance, as the broker has indicated the client's expectation. Option D. Focus primarily on the client's overall loss history and premium adequacy, as the specific wording of the indemnification clause is a legal matter for the client's legal counsel to resolve. The correct answer is B. Analyze the indemnification clause to determine if it is legally enforceable under U.S. contract law and whether the scope of the indemnity is clearly defined. If enforceable and clearly defined, assess how the potential liability flows to the insured under the policy's terms and conditions, considering any relevant exclusions or limitations. Explanation. This scenario presents a professional challenge because it requires the underwriter to navigate the complexities of contract formation and interpretation within the specific regulatory framework governing commercial liability insurance in the United States. The underwriter must not only identify the core elements of a valid contract, but also understand how potential ambiguities or omissions in contractual language can impact coverage and lead to disputes. Careful judgment is required to assess the risk accurately and ensure compliance with all applicable laws and guidelines. The correct approach involves a thorough review of the proposed contract to identify all essential elements of contract formation: offer, acceptance, consideration, and mutual assent. It also necessitates a careful interpretation of the contract's terms and conditions, considering any potential ambiguities in light of established principles of contract law and relevant case precedents within the U.S. jurisdiction. This approach is correct because it directly addresses the underwriter's responsibility to ensure that the insurance policy, as a contract, is legally sound, and that the coverage provided aligns with the agreed-upon terms and the insured's risk profile, thereby adhering to the principles of prudent underwriting and regulatory compliance. An incorrect approach that focuses solely on the insured's stated needs, without verifying the presence of all contractual elements, fails to establish a legally binding agreement. This overlooks the fundamental requirement of offer and acceptance, potentially leaving both parties without a valid contract and exposing the insurer to regulatory scrutiny for issuing a policy without a proper foundation. Another incorrect approach that prioritizes speed of issuance over a detailed review of the contract's interpretation risks misinterpreting ambiguous clauses. This could lead to unintended coverage grants or denials, resulting in claims disputes, financial losses, and potential violations of fair claims practices regulations. The failure to interpret terms accurately, considering established legal principles, is a significant ethical and regulatory lapse. A further incorrect approach that relies on assumptions about industry standard terms without explicit contractual agreement ignores the principle that contracts are binding based on their specific written terms. This can lead to disputes when actual policy language differs from assumed standards, creating coverage gaps or unintended liabilities, and violating the duty of utmost good faith. The professional decision-making process for similar situations should involve a systematic review of all contractual documents, ensuring each element of contract formation is present and clearly documented. Underwriters should be trained to identify and address ambiguities in contract language, seeking clarification or amendment where necessary. They must also be knowledgeable about relevant contract law principles and regulatory requirements to ensure that policies are issued on a sound legal and ethical basis. When in doubt, consulting legal counsel or senior underwriting expertise is a critical step in mitigating risk and ensuring compliance. Question 3. System analysis indicates that an underwriter is evaluating a product liability insurance application for a company that manufactures and sells a new line of electronic gadgets. The company has experienced rapid sales growth in the past year. Which of the following approaches would best align with the regulatory framework for assessing product liability risks associated with manufacturing or selling products? Option A. Focus primarily on the high volume of sales and the company's market share to determine the appropriate premium, assuming that rapid growth indicates a successful and therefore low-risk product. Option B. Accept the manufacturer's assurances regarding product safety and compliance without independent verification, as the company is established and has a good reputation. Option C. Prioritize a thorough review of the manufacturer's quality control processes, product design documentation, safety testing results, and any relevant third-party certifications to identify potential defects and assess the effectiveness of their risk mitigation strategies. Option D. Emphasize the need to offer a competitive premium to secure the business, even if it means conducting a less detailed assessment of the product's inherent risks and the manufacturer's safety protocols. The correct answer is C. Prioritize a thorough review of the manufacturer's quality control processes, product design documentation, safety testing results, and any relevant third-party certifications to identify potential defects and assess the effectiveness of their risk mitigation strategies. Explanation: this scenario is professionally challenging because accurately assessing product liability risks requires a nuanced understanding of the product's lifecycle, potential defects, and the specific regulatory landscape governing its sale and distribution. Underwriters must balance the need to protect their company from undue financial exposure with the imperative to provide adequate coverage for legitimate business risks. The complexity arises from the interconnectedness of manufacturing processes, supply chains, marketing claims, and consumer use, all of which can contribute to liability. Careful judgment is required to identify and quantify these multifaceted risks, moving beyond superficial assessments to a deep dive into the product's inherent safety and the manufacturer's risk management practices. The correct approach involves a comprehensive review of the manufacturer's quality control procedures, historical claims data, product design documentation, and any third-party safety certifications. This approach is right because it directly addresses the core elements of product liability risk as defined by relevant regulations. For instance, under typical product liability frameworks, a claimant must often demonstrate a defect in the product that caused injury or damage. By scrutinizing quality control and design, the underwriter is evaluating the likelihood of such defects arising. Examining historical claims data provides empirical evidence of past issues and their severity, informing future predictions. Regulatory compliance, such as adherence to consumer safety standards, is a critical indicator of a manufacturer's commitment to risk mitigation and directly impacts the likelihood of successful claims. This thoroughness ensures that the premium charged accurately reflects the assessed risk, aligning with the underwriter's duty to both the insurer and the insured. An incorrect approach that focuses solely on the volume of sales without investigating the product's inherent safety or the manufacturer's quality controls is professionally unacceptable. This failure neglects the fundamental principle that high sales volume can amplify the impact of even a small defect rate, leading to a disproportionately high number of claims. Bypasses the regulatory requirement to assess the actual risk posed by the product itself. Another incorrect approach that relies exclusively on the manufacturer's self-reported safety measures without independent verification is also professionally flawed. This approach is susceptible to bias and may overlook critical gaps in the manufacturer's internal processes. It fails to meet the underwriter's responsibility to conduct due diligence and obtain objective evidence of risk mitigation, potentially leading to underpriced policies and significant financial exposure for the insurer, and inadequate coverage for the insured if a major incident occurs. A third incorrect approach that prioritizes market share and competitive pricing over a robust risk assessment is ethically and regulatorily unsound. This approach prioritizes short-term business gains over long-term financial stability and responsible underwriting. It can lead to the acceptance of unacceptable risks, potentially jeopardizing the insurer's solvency and failing to uphold the principles of sound insurance practice. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should begin with understanding the product and its intended use, followed by an evaluation of the manufacturing and distribution processes. Key areas of inquiry include the manufacturer's quality assurance systems, product design and testing protocols, supply chain management, marketing and labeling practices, and historical loss experience. Crucially, The underwriter must cross-reference these findings against applicable regulatory requirements and industry best practices. Where potential risks are identified, the underwriter should seek to understand the mitigation strategies in place and assess their effectiveness. This iterative process of identification, evaluation, and mitigation forms the basis for sound underwriting decisions. Question 4. The evaluation methodology shows that when underwriting commercial liability for a business that routinely receives valuable goods for repair and storage, the underwriter must consider the specific legal and contractual responsibilities arising from the possession of these goods. Which of the following approaches best reflects a compliant and ethically sound underwriting decision regarding Bailey liability for damage to these goods? Option A. Assume that any damage to goods in the insured's possession is covered under their standard commercial general liability policy, as the goods are in their care, custody, or control. Option B. Thoroughly review the insured's contracts with their clients to understand their agreed-upon responsibilities for the goods and assess the adequacy of their existing insurance to cover these specific Bailey exposures. Option C. Rely solely on the general wording of the commercial general liability policy without investigating the specific bailment agreements or industry practices related to the insured's business. Option D. Automatically apply a broad exclusion for all property in the insured's care, custody, or control, regardless of the specific bailment arrangements or contractual obligations. The correct answer is B. Thoroughly review the insured's contracts with their clients to understand their agreed-upon responsibilities for the goods and assess the adequacy of their existing insurance to cover these specific Bailey exposures. Explanation. The evaluation methodology shows that underwriting commercial liability requires a nuanced understanding of Bailey liability, particularly when assessing risks associated with property in one's care, custody, or control. This scenario is professionally challenging because it demands the underwriter to move beyond standard policy language and delve into the specific contractual obligations and industry practices that define the Bailey's duty of care. The underwriter must consider not only the potential for direct damage, but also the cascading financial and reputational impacts on the insured and third parties. The correct approach involves a thorough review of the insured's contractual agreements with their clients, identifying any clauses that explicitly define the scope of their responsibility for property entrusted to them. This includes examining industry standard bailment agreements and any specific endorsements or exclusions within the insured's existing insurance policies. Regulatory justification stems from the principle of accurate risk assessment, ensuring that the policy accurately reflects the exposures undertaken. Ethically, this approach upholds transparency and fairness by ensuring the insured understands their coverage and that the insurer is not exposed to unpriced or unmanaged risks. An incorrect approach would be to rely solely on the general wording of a standard commercial general liability policy without investigating the specific bailment arrangements. This fails to acknowledge that bailment creates a higher duty of care than ordinary negligence, often implying strict liability for damage to bailed property. This approach risks underpricing the risk or providing inadequate coverage, leading to potential claims disputes and regulatory scrutiny for misrepresentation or failure to adequately assess risk. Another incorrect approach is to assume that any damage to property in the insured's possession is automatically covered under their general liability policy, without considering the specific cause of damage and the insured's contractual obligations. This overlooks the nuances of bailment law, where the Bailey's liability can be limited by contract or specific circumstances, and the insurer's liability is tied to the insured's legal obligations. This can lead to coverage disputes and a failure to meet the insurer's duty to underwrite responsibly. A third incorrect approach is to automatically exclude all Bailey liability based on a broad interpretation of care, custody, or control exclusions without understanding the specific nature of the bailment and the insured's role. While exclusions can be relevant, a blanket exclusion without proper analysis ignores the potential for insurable interests and the common practice of insuring Bailey exposures. This can lead to a failure to offer appropriate coverage for legitimate business risks. The professional decision-making process for similar situations should involve a systematic risk assessment framework. This includes 1. Identifying the specific nature of the bailment and the insured's role. 2. Analyzing the contractual obligations between the insured and the bailer. 3. Evaluating the industry practices and common law regarding Bailey liability. 4. reviewing the insured's loss history and risk management practices. 5. Determining the appropriate coverage limits, deductibles, and endorsements to address the identified exposures. This structured approach ensures that underwriting decisions are informed, compliant, and ethically sound. Question 5. Process analysis reveals that a commercial property applicant, a retail store, has not undergone a recent ADA compliance audit, and preliminary information suggests potential accessibility barriers for individuals with mobility impairments. The underwriter must determine the most appropriate course of action to manage the associated liability risk. Option A. Request a detailed ADA compliance report from the applicant, and based on its findings, propose policy terms that reflect the identified risks, potentially including a requirement for a remediation plan. Option B. Decline coverage outright due to the potential for ADA noncompliance without further investigation. Option C. Assume the applicant is compliant with the ADA in the absence of explicit evidence to the contrary and proceed with standard underwriting. Option D. Advise the applicant to obtain an ADA compliance certification from a third-party vendor and use this as the sole basis for underwriting decisions. The correct answer is A. Request a detailed ADA compliance report from the applicant and, based on its findings, propose policy terms that reflect the identified risks, potentially including a requirement for a remediation plan. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the financial interests of the insurer with the legal and ethical obligations to ensure compliance with the Americans with Disabilities Act, ADA. The underwriter must assess the risk associated with a commercial property's accessibility features, understanding that non-compliance can lead to significant legal liabilities, including lawsuits and fines, which directly impact the insurability and premium of the policy. Careful judgment is required to accurately evaluate the extent of potential exposure and to recommend appropriate underwriting actions. The correct approach involves a thorough review of the property's existing accessibility features against ADA standards, identifying specific deficiencies, and then assessing the financial implications of remediation. This includes understanding the potential costs of upgrades, the likelihood of complaints or lawsuits, and the insurer's appetite for such risks. The underwriter should then propose terms that reflect this risk, which may include requiring the insured to implement a remediation plan as a condition of coverage or charging a premium commensurate with the identified risks. This aligns with the underwriter's duty to accurately assess and price risk, while also implicitly encouraging compliance with legal mandates that reduce the likelihood of claims. An incorrect approach would be to ignore or downplay potential ADA noncompliance due to a desire to secure the business or a lack of understanding of the associated liabilities. This failure to adequately assess risk is a direct violation of underwriting principles and could expose the insurer to significant financial losses if claims arise from ADA violations. Another incorrect approach is to simply deny coverage without providing clear reasons or offering alternative solutions, which, while protecting the insurer from immediate risk, fails to engage in a constructive underwriting process that could potentially lead to coverage with appropriate risk mitigation. A third incorrect approach is to assume that the insured's self-certification of compliance is sufficient without any independent verification or inquiry, as this neglects the underwriter's responsibility to conduct due diligence and accurately assess the risk profile of the insured property. Professionals should approach such situations by first understanding the relevant legal framework, in this case, the ADA and any applicable state or local regulations. They should then gather all necessary information about the insured property, including site plans, inspection reports, and any existing accessibility assessments. This information should be analyzed to identify specific compliance gaps and their potential financial and legal ramifications. Based on this analysis, the underwriter should determine the appropriate underwriting action, which may involve requesting further information, proposing specific policy terms and conditions, or declining coverage if the risk is uninsurable. The decision-making process should prioritize accurate risk assessment, adherence to regulatory requirements, and the financial health of the insurance portfolio. Question 6. Market research demonstrates that a significant factor in underwriting commercial liability policies is the analysis of an applicant's past claims experience. When evaluating a prospective insured's loss history, which of the following approaches best aligns with regulatory requirements and professional best practices for assessing current risk? Option A. giving primary consideration to the most recent one or two claims filed, assuming they are the most indicative of future loss potential. Option B, prioritizing a detailed examination of the nature, frequency, severity, and recency of past claims, alongside an assessment of the insured's risk management strategies and the underlying causes of those claims. Option C, relying on general industry loss trends and anecdotal evidence from other underwriters about similar businesses, rather than the applicant's specific loss data. Option D, focusing exclusively on the total dollar amount of all past claims, regardless of the time period or the specific circumstances of each incident. The correct answer is B, prioritizing a detailed examination of the nature, frequency, severity, and recency of past claims, alongside an assessment of the insured's risk management strategies and the underlying causes of those claims. Explanation: this scenario is professionally challenging because evaluating loss history is a cornerstone of underwriting commercial liability, directly impacting risk assessment, pricing, and the insurer's financial stability. Underwriters must balance the need for accurate risk assessment with the potential for bias or misinterpretation of past claims. The regulatory framework for underwriting commercial liability, as defined by the specified exam jurisdiction, which we will assume for this example, is the United States, governed by state-specific insurance regulations and federal guidelines where applicable, such as those from NAIC, mandates fair and non-discriminatory practices. This requires a thorough, objective, and compliant analysis of loss data. The correct approach involves a comprehensive review of the claimant's loss history, focusing on the nature, frequency, severity, and recency of claims, and critically assessing the underlying causes and the effectiveness of any risk management measures implemented by the insured. This approach aligns with regulatory requirements for sound underwriting, which emphasize assessing the actual risk presented by the applicant. It also adheres to ethical obligations to price policies fairly based on risk and to avoid adverse selection. Specifically, regulations often require underwriters to base decisions on objective underwriting criteria and to document the rationale for their decisions, ensuring transparency and compliance with fair claims handling practices and anti-discrimination laws. An incorrect approach that focuses solely on the total dollar amount of past claims without considering the context or the insured's efforts to mitigate future losses fails to adequately assess the current risk. This can lead to unfairly high premiums or denial of coverage, potentially violating regulations that prohibit arbitrary or unfair discrimination. Another incorrect approach that prioritizes only the most recent claims might overlook significant trends or patterns evident in older claims, leading to an incomplete risk assessment and potentially exposing the insurer to unforeseen liabilities. Furthermore, an approach that relies on anecdotal information or industry stereotypes rather than specific loss data is not only unprofessional, but also likely to contravene regulatory mandates for data-driven underwriting decisions and fair treatment of applicants. Professionals should employ a decision-making framework that begins with a clear understanding of the applicant's business operations and the specific risks associated with their industry. This should be followed by a detailed analysis of the loss runs, categorizing claims by type, severity, and cause. Crucially, the underwriter must engage with the applicant to understand the circumstances surrounding past claims, the reasons for their occurrence, and the corrective actions taken. This qualitative assessment, combined with quantitative data, allows for a more accurate and compliant risk evaluation. Documentation of this entire process is essential for regulatory compliance and internal audit purposes. Question 7. Market research demonstrates that a significant portion of commercial property claims arise from damage caused by tenants. When underwriting a commercial property insurance policy for a landlord, what is the most prudent approach to address the liability for damage caused by a tenant's actions or negligence? Option A. Focus solely on the landlord's direct responsibilities for property upkeep and ignore the specific clauses within the lease agreement pertaining to tenant liability for damage. Option B. Assume that all damage caused by a tenant is automatically covered under the landlord's property insurance policy, as the landlord is the policyholder. Option C. Impose a blanket exclusion in the landlord's policy for any damage that originates from a tenant's operations, irrespective of the lease terms or the specific cause of damage. Option D. Thoroughly review the lease agreement to understand the tenant's responsibilities for property maintenance, repair, and indemnification, and assess the tenant's insurance coverage and financial capacity to meet their obligations. Correct answer is D. Thoroughly review the lease agreement to understand the tenant's responsibilities for property maintenance, repair, and indemnification, and assess the tenant's insurance coverage and financial capacity to meet their obligations. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the insurer's need to manage risk and potential claims with the contractual obligations and reasonable expectations of a commercial tenant. The underwriter must accurately assess the likelihood and potential severity of damage caused by a tenant, considering the specific lease terms, the nature of the tenant's business, and the property's characteristics. Misjudging this risk can lead to inadequate premium, leaving the insurer exposed, or to an overly restrictive policy that deters potential clients. The core of the challenge lies in interpreting the lease agreement and applying underwriting principles to a situation where the tenant's actions directly impact the insured property. The correct approach involves a thorough review of the lease agreement to understand the tenant's responsibilities regarding property maintenance, repair, and indemnification. This includes identifying any clauses that shift liability for damage to the tenant or require the tenant to maintain specific insurance. The underwriter must then assess the tenant's financial stability and insurance coverage to ensure they can meet their obligations. This aligns with the regulatory framework's emphasis on prudent underwriting, accurate risk assessment, and ensuring that policy terms reflect the actual exposures. The principle of utmost good faith also dictates that the insurer should not impose unreasonable burdens or exclusions without clear justification based on risk. An incorrect approach that focuses solely on the landlord's property insurance without considering the lease terms fails to acknowledge the contractual allocation of risk. This overlooks the potential for subrogation claims against the tenant, which is a key risk mitigation strategy for the insurer. It also ignores the possibility that the tenant's actions are the direct cause of the damage, which could be excluded or limited under the landlord's policy if not properly managed. Another incorrect approach that assumes all tenant-caused damage is automatically covered by the landlord's policy without due diligence is also professionally unsound. This neglects the underwriter's responsibility to identify and price for specific perils and exposures. Many property policies have exclusions for damage caused by specific tenant activities or negligence if not properly addressed through endorsements or specific tenant insurance requirements. A third incorrect approach that imposes blanket exclusions for any damage originating from a tenant's operations, regardless of the lease terms or the nature of the damage, is overly broad and potentially discriminatory. This fails to differentiate between various types of tenant activities and their associated risks, and it may not be compliant with fair underwriting practices or regulatory requirements that prohibit arbitrary exclusions. The professional decision-making process for similar situations should involve a systematic risk assessment. This begins with understanding the contractual relationship between the landlord and tenant as defined in the lease. The underwriter should then evaluate the tenant's business operations and their potential impact on the property. Next, they must assess the tenant's own insurance arrangements and financial capacity to cover potential liabilities. Finally, the underwriter should determine the appropriate policy terms, conditions, and pricing to reflect the identified risks, ensuring compliance with all applicable regulations and ethical standards. Question 8. Cost-benefit analysis shows that implementing enhanced safety protocols at a manufacturing facility would significantly reduce the likelihood of a major fire, but the upfront investment is substantial. The insured is hesitant due to the immediate cost, which approach best aligns with the underwriter's responsibilities for hazard identification in this scenario. Option A. Accept the insured's assessment that the cost of enhanced safety protocols outweighs the perceived immediate risk, focusing on other, less costly, hazard mitigation measures. Option B. Defer a comprehensive evaluation of the fire hazard, assuming that standard industry practices are sufficient and that the insured will proactively address any emerging issues. Option C. Focus on the immediate cost savings for the insured by approving coverage without requiring the implementation of the enhanced safety protocols, as the primary goal is to secure the business. Option D. Prioritize identifying and assessing the potential severity and likelihood of a major fire, even with high mitigation costs, to ensure adequate premium and coverage terms are established. The correct answer is D. Prioritize identifying and assessing the potential severity and likelihood of a major fire, even with high mitigation costs, to ensure adequate premium and coverage terms are established. Explanation: this scenario is professionally challenging because it requires an underwriter to balance the immediate financial implications of hazard mitigation with the long-term, potentially catastrophic, consequences of inadequate risk assessment. The pressure to reduce immediate costs can conflict with the regulatory and ethical duty to ensure adequate coverage for foreseeable losses. Careful judgment is required to identify and evaluate hazards that, while not immediately apparent or easily quantifiable in terms of cost, pose significant liability risks. The correct approach involves a proactive and comprehensive hazard identification process that prioritizes potential sources of loss based on their severity and likelihood, even if mitigation costs seem high in the short term. This aligns with the core principles of underwriting commercial liability, which mandate a thorough understanding of the insured's operations to accurately assess risk. Regulatory frameworks, such as those governing insurance solvency and consumer protection, implicitly require underwriters to avoid taking on risks that are inadequately priced or understood due to a failure to identify significant hazards. Ethically, underwriters have a duty to act in the best interests of both the insurer, by ensuring sound underwriting, and the insured, by providing appropriate coverage. Ignoring or downplaying potential hazards to reduce immediate costs is a dereliction of this duty, potentially leading to claims that exceed reserves or coverage that is insufficient for the insured's actual exposure. An approach that focuses solely on the immediate cost of implementing hazard controls without a thorough assessment of the potential severity of losses if those controls fail or are absent is professionally unacceptable. This failure to adequately identify and assess hazards can lead to underpricing of risk, which can jeopardize the insurer's financial stability and violate regulatory requirements designed to protect policyholders. Furthermore, it can result in the insured being inadequately protected, leading to significant financial hardship if a claim arises. Another incorrect approach is to rely solely on the insured's self-reported hazard information without independent verification or a deeper investigation into their operational processes. While insureds are expected to provide accurate information, underwriters have a professional responsibility to conduct due diligence. Over-reliance on self-reporting without critical evaluation can lead to missed hazards, particularly those that are systemic or not readily apparent to the insured themselves. This can result in a failure to identify potential sources of loss, contravening the fundamental principles of risk assessment. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes systematically identifying potential hazards through site visits, review of operational procedures, industry-specific knowledge, and historical loss data. Following identification, hazards should be analyzed for their potential impact and likelihood. Mitigation strategies should then be evaluated, considering both the cost of implementation and the reduction in potential loss. The ultimate decision on underwriting terms and pricing should reflect a comprehensive understanding of the identified risks and the effectiveness of proposed controls, ensuring that the premium adequately reflects the exposure and that the coverage is appropriate for the insured's needs, in compliance with all applicable regulations. Question 9. Quality control measures reveal that an underwriter has processed a commercial liability insurance application for a business whose primary operations involve boat repair, maintenance, and occasional client demonstrations of watercraft. The underwriter has issued a standard commercial general liability (CGL) policy without specific endorsements or separate watercraft liability coverage, relying on the general policy wording. Based solely on the regulatory framework and guidelines for the underwriting commercial liability exam, which of the following approaches is the most appropriate for addressing this situation? Option A. Advise the insured that the standard CGL policy excludes all watercraft operations and that no coverage is available. Option B. Issue a policy endorsement that broadly waives the watercraft exclusion for all activities undertaken by the insured, regardless of the specific risk. Option C. Review the policy to determine if the standard watercraft exclusion applies to the insured's core business activities, and if so, explore options for specific watercraft liability coverage or a referral to a specialist underwriter. Option D. Assume the standard CGL policy implicitly covers watercraft operations incidental to the boat repair business, as the exclusion is likely intended for recreational use. Correct answer is A. Advise the insured that the standard CGL policy excludes all watercraft operations and that no coverage is available. Explanation. This scenario presents a professional challenge because it requires the underwriter to distinguish between a standard commercial liability policy exclusion and a specific exclusion for watercraft operations, necessitating a thorough understanding of policy wordings and the nature of the insured's business activities. The underwriter must exercise careful judgment to ensure appropriate coverage is provided without exposing the insurer to unforeseen risks, particularly given the inherent dangers associated with watercraft. The correct approach involves accurately identifying that the insured's primary business is boat repair and maintenance, which inherently involves the use and operation of watercraft. Therefore, the standard commercial general liability policy's exclusion for watercraft operations would likely apply to the business's core activities. The underwriter must then determine if specific watercraft liability coverage is needed and available, or if the risk is entirely excluded. This aligns with the regulatory framework's emphasis on accurate risk assessment and policy application, ensuring that coverage matches the insured's actual operations and that exclusions are applied appropriately based on the policy's intent and the insured's exposure. The principle of utmost good faith also dictates that the insurer clearly communicates the scope of coverage and any limitations. An incorrect approach would be to assume the standard commercial general liability policy automatically covers all aspects of the business, including watercraft operations, without scrutinizing the policy's specific exclusions. This fails to acknowledge the distinct risks associated with watercraft and the common practice of excluding such operations from standard CGL policies, unless specifically endorsed or covered under a separate policy. This approach violates the regulatory requirement for diligent underwriting and accurate risk assessment, potentially leading to claims being denied due to a misunderstanding of coverage. Another incorrect approach would be to automatically deny all coverage based on the presence of watercraft, without considering the nuances of the insured's operations. While watercraft operations are often excluded, the extent of the exclusion and the possibility of specific endorsements or separate policies for watercraft liability must be investigated. This overly broad denial demonstrates a lack of understanding of the insurance market and underwriting principles, failing to provide a fair and accurate assessment of the risk. This can lead to regulatory scrutiny for unfair claims handling or misrepresentation of policy terms. A further incorrect approach would be to apply the watercraft exclusion only to the incidental use of watercraft by employees for personal reasons, while overlooking its application to the core business operations of boat repair and maintenance. This misinterprets the scope of the exclusion, which is typically intended to apply to the business's operational risks involving watercraft, not just minor, non-business-related use. The selective application of exclusions is a failure of diligent underwriting and can result in significant coverage gaps and disputes. The professional decision-making process for similar situations should involve a systematic review of the insured's business activities, a detailed examination of the proposed policy's terms and conditions, and a clear understanding of relevant exclusions. Underwriters should consult policy wordings, underwriting guidelines, and, if necessary, seek clarification from legal or claims departments. The goal is to ensure that the policy accurately reflects the risk and provides appropriate coverage, while also protecting the insurer from uninsurable exposures. This involves a proactive approach to identifying potential coverage gaps and communicating these clearly to the insured. Question 10. Operational review demonstrates that a commercial client, a food manufacturing company, is proposing to introduce a new production line for a novel processed food product. This new line involves significantly different ingredients and a more automated process compared to their existing operations. The underwriter is considering the implications for the company's commercial liability insurance. Which of the following approaches best addresses the potential impact on the company's duty of care to its customers? Option A. Assume that the existing commercial liability policy adequately covers any potential issues arising from the new production line, as the company has a good claims history. Option B. Focus primarily on the increased revenue the new product line is expected to generate and adjust the premium accordingly, without delving into the specifics of the operational changes. Option C. Rely on the company's internal assurances that all necessary safety checks are being performed, without independent verification or detailed inquiry into the specific changes. Option D. Conduct a detailed review of the new production line's processes, ingredient sourcing, quality control measures, and any new safety protocols implemented to ensure the product is safe for consumption and that the company is meeting its duty of care to consumers. The correct answer is D. Conduct a detailed review of the new production line's processes, ingredient sourcing, quality control measures, and any new safety protocols implemented to ensure the product is safe for consumption and that the company is meeting its duty of care to consumers. Explanation. This scenario presents a professional challenge because it requires the underwriter to balance the need to accurately assess risk for the insurer with the fundamental legal and ethical obligation to ensure the insured's operations do not create unreasonable risks for third parties. The core of the challenge lies in interpreting the insured's proposed operational changes and their potential impact on the duty of care owed to customers, employees, and the general public. A failure to adequately address these potential risks could lead to significant liability for the insured, and consequently, for the insurer, if claims arise from breaches of duty of care. The correct approach involves a thorough investigation into the specific nature of the proposed operational changes and their direct implications for the insured's duty of care. This includes understanding how these changes might increase the likelihood of harm to others, whether through product defects, unsafe working conditions, or negligent service delivery. The underwriter must then assess whether the insured has implemented appropriate risk mitigation measures, such as enhanced training, updated safety protocols, or improved quality control processes, to counter these increased risks. This proactive risk assessment and management is aligned with the principles of sound underwriting and the insurer's responsibility to underwrite risks that are understood and manageable within the policy terms. It also indirectly supports the insured's own legal obligations by encouraging robust risk management practices. An incorrect approach would be to dismiss the operational changes as minor or irrelevant without a detailed review of their potential impact on the duty of care. This failure to investigate could lead to the insurer accepting a risk that is significantly higher than anticipated, potentially exposing both the insured and the insurer to substantial financial losses and reputational damage. Another incorrect approach would be to assume that the insured's existing general liability insurance automatically covers all potential breaches of duty of care arising from these new operations, without considering whether the policy's terms and conditions, including any exclusions or endorsements, are still appropriate. This oversight ignores the principle that insurance coverage is based on a clear understanding and acceptance of the risks being insured. A further incorrect approach would be to focus solely on the financial premium, without adequately considering the underlying operational risks and the insured's adherence to their legal duties. This prioritizes profit over responsible risk management and could result in underwriting a policy that is ultimately unsupportable. The professional decision-making process for similar situations should involve a systematic evaluation of any proposed changes to an insured's operation. This process should begin with identifying the nature of the changes and then assessing their potential impact on all relevant duties of care. This includes considering the specific legal obligations the insured owes to different parties. Following this, the underwriter must evaluate the insured's existing and proposed risk management strategies to determine if they are adequate to mitigate the identified risks. If deficiencies are found, the underwriter should engage with the insured to discuss necessary improvements or consider adjustments to the policy terms, such as endorsements or increased premiums, to reflect the altered risk profile. This collaborative and analytical approach ensures that the insurer is making informed decisions based on a comprehensive understanding of the risks involved. Question 11. What factors determine the appropriate assessment of product liability risk for a new product being launched by an existing commercial client with a history of insuring other product lines? Option A. A detailed review of the new product's design, materials, intended use, potential failure modes, and the manufacturer's quality control specific to this product, alongside an analysis of the client's relevant claims history and risk management practices for similar products. Option B. The projected revenue and profit margins associated with the new product's market launch, irrespective of its inherent liability exposures. Option C. The client's overall financial performance and market share projections for the new product, assuming it will carry the same risk profile as their existing insured products. Option D. A review of the client's historical claims data for all their existing product lines, without specific investigation into the new product's Unique characteristics. The correct answer is A. A detailed review of the new product's design, materials, intended use, potential failure modes, and the manufacturer's quality control specific to this product, alongside an analysis of the client's relevant claims history and risk management practices for similar products. Explanation. Scenario analysis. This scenario presents a common challenge in commercial liability underwriting, assessing the risk associated with a new product launch by an established manufacturing client. The challenge lies in balancing the client's desire for market expansion with the underwriter's responsibility to accurately price risk and ensure the insurer's solvency. The underwriter must move beyond historical data for the client's existing product lines and proactively evaluate the novel risks introduced by the new product, which may have different materials, manufacturing processes, distribution channels, and target markets. This requires a forward-looking, analytical approach rather than a reactive one. Correct approach analysis. The correct approach involves a comprehensive review of the new product's design specifications, intended use, potential failure modes, and the manufacturer's quality control processes for this specific product. This includes understanding the materials used, the complexity of the manufacturing, the intended consumer base, and any unique distribution or marketing strategies. Furthermore, it requires an assessment of the client's product liability history, particularly any claims related to design defects or manufacturing errors, and how these might be exacerbated or mitigated by the new product. This detailed, product-specific risk assessment aligns with the fundamental principles of underwriting, which mandate a thorough understanding of the risk being insured to ensure appropriate pricing and coverage terms. Regulatory frameworks, such as those governing insurance solvency and fair practices, implicitly require underwriters to make informed decisions based on a realistic appraisal of potential losses, which necessitates this granular level of investigation. Incorrect approaches analysis, relying solely on the client's historical claims data for their existing product lines, without a specific deep dive into the new product, is an insufficient approach. This fails to account for the unique risk profile of the new product, which may introduce entirely new types of liabilities or significantly alter the frequency and severity of existing ones. This approach risks underpricing the coverage, potentially leading to financial losses for the insurer and failing to adequately protect the insured against the full spectrum of potential claims. Assuming the new product carries the same risk profile as the client's current offerings simply because it is from the same manufacturer is a flawed assumption. It overlooks critical differences in product design, materials, manufacturing processes, intended use, and market exposure, all of which are fundamental drivers of liability risk. This can lead to inadequate risk mitigation strategies and inappropriate premium levels. Focusing exclusively on the potential market share and profitability of the new product, without a commensurate focus on the associated liability risks, represents a failure to adhere to core underwriting principles. While market potential is a commercial consideration, it cannot supersede the primary duty of the underwriter to assess and price risk accurately. This approach prioritizes revenue generation over prudent risk management, which is contrary to the regulatory mandate of maintaining insurer solvency and protecting policyholders. Professional reasoning. Professionals should adopt a structured, risk-based approach to underwriting. This involves 1. Understanding the insured and the risk. Thoroughly investigate the nature of the business, its operations, and the specific product or service being insured. 2. Risk identification. Proactively identify all potential sources of liability associated with the insured's activities or products. 3. Risk analysis. Quantify and qualify the identified risks, considering factors such as frequency, severity, and potential impact. 4. Risk evaluation. Determine the acceptability of the identified risks based on the insurer's risk appetite and underwriting guidelines. 5. Risk treatment. Develop appropriate strategies for managing unacceptable risks, which may include pricing, coverage limitations, or requiring risk control measures. 6. Monitoring and review. Continuously monitor the risk environment and review underwriting decisions as circumstances change. This systematic process ensures that underwriting decisions are informed, defensible, and aligned with regulatory requirements and ethical obligations. Question 12. Examination of the data shows that a small, family-owned catering business, operated by an individual who recently immigrated to the country, has applied for commercial general liability insurance. The underwriter notes that the business operates primarily at outdoor events and has a history of minor, quickly resolved customer complaints related to food temperature. While the business's claims history is otherwise clean, the underwriter personally believes that businesses owned by recent immigrants may be more prone to operational oversights and potential future litigation due to unfamiliarity with local regulations. The underwriter is considering adjusting the premium based on this personal belief. Which of the following approaches best upholds ethical underwriting principles and regulatory compliance? Option A. Offer a significantly reduced premium to the business to secure their patronage, despite the identified risk factors, as a gesture of goodwill towards new businesses in the community. Option B. Underwrite the risk based solely on objective factors such as the business's operational exposures, outdoor events, claims history, and the nature of past customer complaints, applying standard underwriting guidelines without regard to the owner's immigration status or the underwriter's personal beliefs. Option C. Decline coverage for the business due to the perceived higher risk associated with businesses operated by recent immigrants, regardless of other risk factors. Option D. Adjust the premium upwards based on the underwriter's personal belief that businesses operated by recent immigrants may be more prone to operational oversights, while also considering the outdoor event operations and past minor complaints. Correct answer is D. Adjust the premium upwards based on the underwriter's personal belief that businesses operated by recent immigrants may be more prone to operational oversights, while also considering the outdoor event operations and past minor complaints. Explanation: this scenario presents a professional challenge because it requires the underwriter to balance the company's financial interests with the ethical obligation to treat all potential clients fairly and without prejudice. The underwriter has access to information that could be used to justify a higher premium or denial of coverage, but the ethical imperative is to ensure that such decisions are based on objective risk assessment and not on personal biases or the desire to exploit a perceived vulnerability. Maintaining integrity and fairness in underwriting is paramount to upholding public trust in the insurance industry and adhering to regulatory standards designed to prevent discriminatory practices. The correct approach involves a rigorous and objective assessment of the applicant's risk profile, strictly adhering to established underwriting guidelines and regulatory requirements. This means evaluating the business's operations, industry, claims history, and other relevant risk factors, without allowing personal opinions or assumptions about the business owner's background to influence the decision. The underwriter must ensure that any premium adjustments or coverage limitations are directly and demonstrably linked to quantifiable risks and are applied consistently across all similar risks. This approach aligns with the core ethical principles of fairness, honesty, and professional responsibility, and it directly supports compliance with regulations prohibiting unfair discrimination in insurance underwriting. An incorrect approach would be to leverage the underwriter's personal perception of the business owner's potential for future claims, based on assumptions rather than concrete data, to impose a higher premium. This action violates the principle of fairness by penalizing the applicant based on speculation rather than objective risk assessment. It also undermines the integrity of the underwriting process by introducing subjective bias, which can lead to discriminatory outcomes and potential regulatory violations. Another incorrect approach would be to offer a significantly lower premium to secure the business, despite identifying genuine risk factors that would typically warrant a higher premium or specific endorsements. This action compromises the company's financial stability by underpricing risk and can be seen as an attempt to circumvent established underwriting standards. It also creates an unfair advantage over other businesses with similar risk profiles who are charged appropriate premiums, thereby eroding market fairness and potentially violating regulatory principles of equitable treatment. A professional decision-making process for similar situations should involve a clear understanding and application of the underwriting manual and relevant regulatory guidelines. When faced with information that could lead to a subjective decision, the underwriter should pause and ask, is this decision based on objective risk factors as defined by our guidelines, or is it influenced by personal bias or assumptions? If there is any doubt, the underwriter should consult with senior underwriters or underwriting management to ensure the decision is sound, fair, and compliant. The focus must always remain on assessing and pricing risk accurately and equitably, in accordance with established standards and ethical obligations. Question 13. When evaluating the commercial liability insurance needs of a chemical manufacturing facility, which approach best identifies and quantifies the unique risks associated with its specific production processes and waste management protocols? Option A. Relying on the facility's self-reported risk management practices and assuming that standard liability coverage is sufficient for most chemical manufacturing operations. Option B. Conducting a detailed review of the facility's safety data sheets for all chemicals used, examining its waste disposal contracts and procedures, and assessing the potential for environmental contamination and public health impacts arising from its specific manufacturing operations. Option C. Focusing primarily on the value of the facility's property and equipment to determine the potential for business interruption claims, as this often correlates with overall liability exposure. Option D. Analyzing the facility's claims history over the past 5 years and comparing its loss ratios to industry benchmarks for chemical manufacturers. The correct answer is D. Analyzing the facility's claims history over the past 5 years and comparing its loss ratios to industry benchmarks for chemical manufacturers. Explanation. This scenario presents a professional challenge because underwriters must accurately assess the diverse and potentially severe liability exposures arising from manufacturing processes. The complexity stems from the variety of materials, machinery, operational procedures, and the potential for widespread harm to employees, the public, and the environment. A failure to adequately identify and price these risks can lead to significant financial losses for the insurer and inadequate protection for the insured. Careful judgment is required to differentiate between standard operational risks and those that are unique, emergent, or exacerbated by specific manufacturing activities. The correct approach involves a detailed, process-specific risk assessment that considers the entire life cycle of the manufactured product, from raw material handling to finished goods distribution, and the associated potential for bodily injury, property damage, and environmental contamination. This approach aligns with the fundamental principles of underwriting, which mandate a thorough understanding of the risk being insured. Specifically, it adheres to regulatory frameworks that require insurers to underwrite risks prudently and to maintain solvency, ensuring they can meet their obligations to policyholders. Ethically, it upholds the duty to provide fair and accurate coverage based on a comprehensive evaluation of the hazards. An incorrect approach that focuses solely on historical claims data without a deep dive into current manufacturing processes fails to account for changes in technology, materials, or safety protocols, potentially underestimating current risks. This can lead to inadequate premium collection and a failure to meet the insurer's obligation to charge rates commensurate with the risk, potentially violating solvency regulations. Another incorrect approach that relies on broad industry averages without considering the specific operational controls and risk mitigation strategies of the individual manufacturer overlooks critical differentiators. This can result in mispricing and a failure to identify unique or elevated risks, contravening the principle of accurate risk assessment and potentially leading to adverse selection. An approach that prioritizes speed of quoting over thoroughness, neglecting to investigate the specific machinery, chemical usage, or waste disposal practices, risks overlooking significant liability exposures. This haste can lead to coverage gaps and a failure to comply with underwriting standards that demand due diligence, potentially exposing the insurer to unmanaged catastrophic losses. Professionals should employ a decision-making framework that begins with a comprehensive information gathering phase, including detailed questionnaires, site visits, where feasible, and review of safety data sheets and operational manuals. This information should then be analyzed through the lens of potential liability exposures, considering the likelihood and severity of claims. Risk mitigation strategies employed by the manufacturer should be evaluated to determine their effectiveness in reducing the identified exposures. Finally, the premium and policy terms should be set to reflect the residual risk, ensuring both profitability for the insurer and appropriate coverage for the insured, in compliance with all applicable regulations and ethical standards. Question 14. The risk matrix shows that Company X has a significantly declining current ratio over the past 3 fiscal years, while its debt-to-equity ratio has steadily increased. The underwriter is considering the implications of these trends for a commercial general liability policy renewal. Which of the following analytical approaches best reflects a prudent underwriting assessment of the financial risk presented by these trends. Option A. Conclude that the increasing debt-to-equity ratio is a positive indicator of growth and investment, and therefore does not represent an increased liability risk. Option B. Analyze the trends and interrelationships of the current and debt-to-equity ratios in conjunction with other relevant financial indicators to assess the company's overall financial stability and its potential capacity to manage liabilities. Option C. Focus on the absolute values of the current and debt-to-equity ratios to determine if they fall within predefined acceptable ranges, disregarding the directional trends. Option D. Prioritize the current ratio as the sole determinant of financial risk, as it directly reflects the company's ability to meet its immediate obligations. The correct answer is C. Focus on the absolute values of the current and debt-to-equity ratios to determine if they fall within predefined acceptable ranges, disregarding the directional trends. Explanation: this scenario is professionally challenging because it requires an underwriter to move beyond a superficial review of financial statements and instead interpret the implications of financial ratios for potential commercial liability risk. The challenge lies in discerning which ratios, when analyzed in context, provide the most insightful indicators of a company's operational stability, its ability to manage its liabilities, and its potential for future claims. A purely mathematical approach is insufficient. The underwriter must apply judgment informed by regulatory expectations for prudent risk assessment. The correct approach involves analyzing the trend and interrelationship of key financial ratios to identify potential red flags that could signal increased liability exposure. This includes examining ratios that reflect liquidity, solvency, and profitability. For instance, a declining current ratio might indicate an inability to meet short-term obligations, potentially leading to operational shortcuts that increase liability risk. Similarly, a rising debt-to-equity ratio could suggest increased financial leverage and a greater reliance on borrowed funds, which might correlate with a higher risk appetite or a more aggressive business strategy that could result in more claims. Regulatory frameworks for commercial liability underwriting emphasize a thorough and forward-looking assessment of risk, which necessitates understanding the story these financial metrics tell about the insured's business operations and financial health. This approach aligns with the principle of underwriting for sound risk, ensuring that premiums adequately reflect the potential for loss, and that the insurer is not exposed to undue financial strain. An incorrect approach would be to focus solely on a single, isolated financial ratio, without considering its trend or its relationship to other financial indicators. For example, simply noting a high profit margin without investigating the underlying operational factors or the industry context could be misleading. A high profit margin might be achieved through cost-cutting measures that compromise safety protocols, thereby increasing liability risk. Another incorrect approach is to disregard financial ratios altogether, relying solely on qualitative information. This fails to meet the regulatory expectation of a comprehensive risk assessment, as financial health is a critical determinant of a company's capacity to manage and absorb potential liabilities. Furthermore, an approach that prioritizes superficial metrics over those that reveal underlying operational stability or financial strain would be professionally deficient, as it would not adequately identify potential sources of liability. The professional decision-making process for similar situations involves a structured, analytical approach. First, identify the key financial ratios relevant to the specific industry and the type of commercial liability being underwritten. Second, analyze the trends of these ratios over several reporting periods to identify any deterioration or significant fluctuations. Third, consider the interrelationships between different ratios and how they collectively paint a picture of the company's financial health and operational risk profile. Finally, integrate this financial analysis with other underwriting information, such as the company's claims history, operational practices, and market conditions, to form a holistic view of the risk. This systematic process ensures that all relevant factors are considered, leading to a more accurate and defensible underwriting decision. Question 15. Risk assessment procedures indicate that a large, multi-location electronics retailer is seeking commercial liability insurance. Which of the following approaches would be most appropriate for underwriting this risk? Option A. relying on industry-wide average claims data for the electronics retail sector to determine appropriate premium rates and coverage limits. Option B, reviewing the retailer's detailed operational procedures, including customer service protocols, product handling and storage, and premises maintenance and security measures, to identify specific risk management strengths and weaknesses. Option C, evaluating the retailer's current commercial liability insurance policy and assuming their past coverage reflects adequate risk management practices. Option D, primarily assessing the value and nature of the electronics products sold, assuming that higher value or more complex items inherently carry greater liability. The correct answer is B, reviewing the retailer's detailed operational procedures, including customer service protocol, product handling and storage, and premises maintenance and security measures, to identify specific risk management strengths and weaknesses. Explanation. Scenario analysis. This scenario is professionally challenging because it requires an underwriter to move beyond a superficial understanding of retail operations and delve into the specific, often nuanced, risks that can lead to significant liability claims. The sheer volume and variety of customer interactions, product handling, and premises management in a retail environment create a complex web of potential exposures. A failure to accurately assess these risks can lead to underpricing the risk, inadequate policy terms, or even outright rejection of coverage, all of which have financial and reputational consequences for both the insurer and the insured. Careful judgment is required to distinguish between common operational issues and those that represent a material increase in liability exposure. Correct approach analysis. The correct approach involves a comprehensive review of the retailer's specific operational procedures, including their customer service protocols, product handling and storage practices, and their approach to premises maintenance and security. This deep dive allows the underwriter to identify potential gaps in risk management that could lead to claims such as slip and fall incidents, product liability issues, or even theft-related liabilities. Specifically, for a retail operation, this would involve examining evidence of regular safety inspections, staff training on customer assistance and incident reporting, and adherence to relevant health and safety regulations. This thoroughness aligns with the underwriting principle of accurately pricing risk based on a detailed understanding of the exposure, ensuring the policy provides appropriate coverage without exposing the insurer to undue risk. This is consistent with the general principles of prudent underwriting and the duty to assess risk diligently, as expected under regulatory frameworks governing insurance operations, which emphasize fair treatment of customers and sound financial management. Incorrect approaches analysis. One incorrect approach would be to rely solely on industry averages for retail liability without considering the specific operational characteristics of the individual business. This fails to acknowledge that even within the retail sector, operational practices can vary significantly, leading to different risk profiles. This approach is ethically problematic as it does not provide a tailored assessment, potentially leading to unfair pricing or coverage terms for the insured. It also fails to meet the regulatory expectation of due diligence in risk assessment. Another incorrect approach would be to focus only on the types of products sold, such as high-value electronics or flammable materials, without adequately considering the associated liability risks stemming from customer interaction and premises management. While product type is a factor, it is not the sole determinant of liability. For instance, a retailer selling seemingly low-risk items could still face significant liability due to poor store layout, inadequate staffing, or a lack of clear signage, leading to accidents. This approach is flawed because it overlooks critical areas of potential liability that are inherent to the retail environment itself. A third incorrect approach would be to assume that a retailer's existing insurance coverage automatically signifies effective risk management. Past insurance history, while informative, does not guarantee that current practices are robust or that new risks have not emerged. This approach is a failure of professional judgment, as it abdicates the underwriter's responsibility to conduct an independent and current assessment of the risk. It could lead to the continuation of coverage for a business whose risk profile has actually increased, thereby exposing the insurer to unforeseen losses. Professional reasoning. Professionals should adopt a systematic and evidence-based approach to underwriting. This involves gathering detailed information about the insured's operations, understanding the specific risks associated with their industry and business model, and evaluating their existing risk management controls. When assessing retail operations, This means looking beyond broad categories and examining the granular details of how the business operates daily. Professionals should ask probing questions, request supporting documentation, e.g., safety manuals, training records, incident reports, and consider the regulatory environment in which the retailer operates. The decision-making process should be guided by the principle of accurate risk assessment, aiming to provide fair and appropriate coverage while protecting the insurer's financial stability. Question 16. Regulatory review indicates that a large hospital system is seeking a renewal of its commercial liability insurance. The underwriter has access to the hospital's claims history for the past 5 years, which shows a moderate number of slip and fall incidents and a few minor medical malpractice claims. However, the underwriter is aware of recent significant changes in healthcare technology adoption, including the implementation of a new electronic health record system and increased use of telehealth services, which introduce novel liability exposures. Which approach best addresses the underwriting challenge presented by these evolving risks? Option A. Conducting a comprehensive review of the hospital's current risk management protocols, including specific assessments of their cybersecurity measures for the new EHR system, their protocols for telehealth patient consent and privacy, and their staff training on these new technologies, in addition to analyzing the historical claims data. Option B. Prioritizing the renewal of the policy at a competitive premium to retain the client, with a minimal review of the new technological exposures, assuming the hospital has adequate internal controls. Option C. Relying solely on the historical claims data to assess the risk and determine renewal terms, assuming past performance is indicative of future outcomes. Option D. Delegating the assessment of the new technological risks entirely to the hospital's internal risk management department without independent verification by the underwriter. The correct answer is C. Relying solely on the historical claims data to assess the risk and determine renewal terms, assuming past performance is indicative of future outcomes. Explanation. This scenario presents a professional challenge for a commercial liability underwriter due to the inherent complexity and evolving nature of risks within healthcare facilities. The underwriter must navigate a landscape where medical advancements, regulatory changes, and patient expectations constantly shift, demanding a nuanced understanding beyond standard risk assessment. The challenge lies in accurately quantifying and pricing these multifaceted risks, ensuring adequate coverage without imposing prohibitive premiums, all while adhering to stringent regulatory requirements. Careful judgment is required to balance the insurer's need for profitability with the insured's need for comprehensive protection. The correct approach involves a proactive and data-driven risk management strategy, emphasizing continuous monitoring and adaptation. This approach is right because it aligns with the regulatory framework's emphasis on thorough due diligence and the principle of utmost good faith. By actively engaging with the medical facility to understand their specific risk mitigation efforts, implementing robust internal protocols for claims analysis, and staying abreast of emerging healthcare liabilities, the underwriter demonstrates a commitment to accurate risk assessment and fair pricing. This proactive stance helps prevent adverse selection and ensures that policy terms and conditions accurately reflect the current risk profile, thereby fulfilling the underwriter's fiduciary duty. An incorrect approach that relies solely on historical claims data, without considering current operational changes or emerging risks, fails to meet regulatory expectations for a dynamic risk assessment. This approach is ethically flawed as it may lead to underpricing coverage, potentially exposing the insurer to unforeseen losses, or overpricing, unfairly burdening the insured. Another incorrect approach that prioritizes premium generation over comprehensive risk evaluation neglects the underwriter's responsibility to ensure the insured has appropriate coverage for their specific exposures. This can lead to coverage gaps and ultimately harm the insured when a claim arises, violating the principle of providing adequate protection. A third incorrect approach that delegates risk assessment entirely to external consultants without independent verification by the underwriter bypasses critical internal control mechanisms and may result in a superficial understanding of the facility's true risk profile, potentially leading to mispriced policies and regulatory noncompliance. Professionals should adopt a decision-making framework that begins with a thorough understanding of the specific regulatory environment governing healthcare liability. This involves not only reviewing the insured's operational data, but also actively seeking information on their risk management programs, quality control measures, and compliance with healthcare regulations. The underwriter must then synthesize this information with industry, best practices, and emerging risk trends. Regular communication with the insured and ongoing review of their operations are crucial to maintaining an accurate risk assessment throughout the policy period. This iterative process ensures that underwriting decisions are informed, ethical, and compliant with all applicable laws and guidelines. Question 17. The monitoring system demonstrates a significant increase in harsh braking and rapid acceleration events recorded by telematics devices across a commercial fleet, insured for automobile liability over the past quarter. The insured has provided updated mileage declarations and confirmed the types of vehicles in the fleet remain consistent. Which of the following approaches best aligns with prudent underwriting practices and regulatory expectations for assessing this evolving risk profile? Option A. Increasing the premium by a standard percentage for all commercial auto policies experiencing any telematics alerts without specific analysis of the events. Option B. Accepting the updated mileage declarations and vehicle types as sufficient indicators of risk and maintaining the current premium. Option C. Requesting detailed telematics reports, driver training certifications, and vehicle maintenance logs for further review to adjust the premium and terms accordingly. Option D. Relying solely on the insured's claims history over the past 3 years to determine if the increased telematics events warrant a premium adjustment. The correct answer is C. Requesting detailed telematics reports, driver training certifications, and vehicle maintenance logs for further review to adjust the premium and terms accordingly. Explanation: this scenario is professionally challenging because it requires the underwriter to balance the need for comprehensive risk assessment with the practicalities of underwriting commercial automobile liability. The core challenge lies in determining the appropriate level of scrutiny for a fleet operation, where the risk profile can fluctuate significantly based on driver behavior, vehicle maintenance, and operational scope. A failure to adequately assess these factors could lead to underpricing the risk, resulting in potential financial losses for the insurer, or overpricing it, making the policy uncompetitive. The underwriter must navigate the specific regulatory framework governing commercial automobile liability in the relevant jurisdiction to ensure compliance and sound underwriting practices. The correct approach involves a thorough review of telematics data, driver training records, and maintenance logs. This method is correct because it directly addresses the key drivers of automobile liability risk for commercial fleets. Telematics data provides objective insights into driving habits, speeding, harsh braking, acceleration, which are direct indicators of accident potential. Driver training records demonstrate the insurer's commitment to mitigating human error, a significant factor in liability claims. Maintenance logs confirm the roadworthiness of the vehicles, reducing the likelihood of mechanical failures contributing to accidents. Adherence to these practices aligns with the principles of prudent underwriting and regulatory expectations for assessing commercial auto risks, ensuring that premiums accurately reflect the exposure. An incorrect approach that relies solely on the insured's self-reported mileage and vehicle types is professionally unacceptable. This method fails to incorporate objective data and relies heavily on potentially inaccurate or incomplete information provided by the applicant. It neglects critical risk factors such as driver behavior and vehicle condition, which are not captured by simple mileage and vehicle classification. This approach risks significant underestimation of the actual exposure, leading to inadequate premium collection and potential financial strain on the insurer, and it may also violate regulatory requirements for due diligence in risk assessment. Another incorrect approach that focuses exclusively on the insured's claims history without considering current operational data is also professionally unsound. While claims history is a valuable indicator of past performance, it does not necessarily reflect the current risk profile. A fleet's risk can change due to new drivers, altered routes, or changes in maintenance practices. Ignoring real-time operational data and telematics in favor of historical data alone means the underwriter is not assessing the current risk accurately, potentially leading to mispricing and non-compliance with underwriting standards that mandate a forward-looking risk assessment. A professional decision-making process for similar situations should begin with identifying the specific regulatory requirements for commercial automobile liability underwriting in the applicable jurisdiction. This should be followed by a comprehensive risk assessment that utilizes all available relevant data, including telematics, driver information, maintenance records, and claims history. The underwriter must then analyze this data to identify key risk drivers and determine appropriate pricing and coverage terms. Finally, the underwriter should document their rationale and the data used to support their underwriting decision, ensuring transparency and auditability. Question 18. Benchmark analysis indicates that a significant portion of commercial liability claims arise from specific operational exposures. When underwriting a policy for a manufacturing firm that produces specialized industrial machinery, which of the following approaches best reflects a diligent and compliant assessment of potential product liability risks? Option A. Focusing primarily on the applicant's financial statements to determine their capacity to absorb potential claims, rather than investigating the inherent risks of their products. Option B. Assuming that the applicant's existing general liability insurance adequately covers product liability exposures, and therefore requiring minimal additional underwriting scrutiny. Option C. Relying on general industry loss data for manufacturing firms and applying a standard product liability premium adjustment based on sales volume. Option D. Conducting a detailed review of the applicant's product design and testing protocols, examining their quality control processes, and assessing their contractual indemnification clauses with distributors and end users. The correct answer is C. Relying on general industry loss data for manufacturing firms and applying a standard product liability premium adjustment based on sales volume. Explanation. This scenario is professionally challenging because it requires the underwriter to balance the need to accurately assess and price risk with the potential for adverse selection and the ethical obligation to treat all applicants fairly. The underwriter must navigate the complexities of specific liability exposures, such as product liability, professional indemnity, and environmental liability, understanding that each carries unique risk profiles and regulatory considerations. The challenge lies in discerning genuine risk factors from those that might be exaggerated or misrepresented, while ensuring that underwriting decisions are based on sound principles and comply with all applicable regulations. The correct approach involves a thorough and systematic review of the applicant's operations, historical claims data, risk management practices, and industry-specific exposures. This includes engaging with the applicant to gain a comprehensive understanding of their business and potential liabilities. Regulatory compliance is paramount, ensuring that all underwriting decisions align with the principles of fair treatment of customers and solvency requirements. This approach is correct because it is grounded in a diligent assessment of risk, supported by evidence, and adheres to the regulatory framework governing commercial liability insurance. It prioritizes accurate risk classification and pricing, which is fundamental to the financial health of the insurer and the stability of the insurance market. An incorrect approach would be to rely solely on industry averages or broad classifications, without delving into the specifics of the applicant's operations. This fails to account for unique risk factors and can lead to either underpricing, exposing the insurer to excessive losses, or overpricing, unfairly burdening the applicant. Another incorrect approach would be to make assumptions about the applicant's risk profile based on superficial information or anecdotal evidence, without seeking clarification or verification. This demonstrates a lack of due diligence and can result in inaccurate underwriting decisions that violate regulatory principles of fairness and sound risk management. Furthermore, ignoring specific regulatory requirements related to certain liability exposures, such as those pertaining to environmental pollution or data breaches, would constitute a significant ethical and regulatory failure. Professionals should employ a decision-making framework that begins with a clear understanding of the applicant's business and its associated liability exposures. This should be followed by a detailed risk assessment, incorporating all available data and seeking further information where necessary. The underwriter must then evaluate the applicant's risk management strategies and their effectiveness. Finally, all decisions must be made within the strict confines of the applicable regulatory framework, ensuring compliance with all laws and guidelines. This systematic and evidence-based approach, coupled with a commitment to regulatory adherence, ensures sound underwriting practices. Question 19. Compliance review shows that an underwriter is evaluating a complex commercial construction project involving novel building materials and a tight deadline. The underwriter is considering two primary approaches to assess the associated liability risks. 1. Applying a standard underwriting template based on typical construction project exposures, and 2. Conducting a detailed, project-specific risk assessment that includes interviews with the project manager, review of site-specific safety plans, and an evaluation of the contractor's experience with similar innovative materials. Which approach best aligns with the regulatory framework for underwriting commercial liability in this jurisdiction, and why? Option A. Conducting a detailed project-specific risk assessment. Option B. Relying on the project's insurance broker's general assessment of risk. Option C. Prioritizing speed of issuance over detailed risk evaluation to meet market demand. Option D. Applying a standard underwriting template based on typical construction project exposures. The correct answer is A. Conducting a detailed project-specific risk assessment. Explanation. This scenario presents a professional challenge for a commercial liability underwriter due to the inherent complexities and evolving nature of construction risks. The underwriter must balance the need to accurately assess and price these risks against the potential for significant financial losses arising from project delays, defects, accidents, and third-party claims. The challenge lies in interpreting and applying the specific regulatory framework for the exam jurisdiction, which dictates how construction project risks must be evaluated and insured. Careful judgment is required to ensure that policy terms, conditions, and pricing adequately reflect the identified exposures without unduly penalizing the insured or leaving the insurer exposed to unmanaged liabilities. The correct approach involves a thorough review of the construction project's specific risk management strategies, including site safety protocols, quality control measures, and the experience of the contractors involved. This aligns with the regulatory framework's emphasis on due diligence and risk mitigation. Specifically, the underwriter must ensure that the proposed insurance coverage is commensurate with the identified risks, and that all policy exclusions are clearly understood and appropriately applied. This proactive and detailed assessment is ethically mandated to provide fair and adequate coverage while adhering to solvency requirements and underwriting standards. An incorrect approach would be to rely solely on historical loss data for similar projects without a granular analysis of the current project's unique characteristics. This fails to account for project-specific variables such as innovative construction methods, site conditions, or changes in regulatory compliance, potentially leading to underpricing or inadequate coverage. This approach violates the regulatory requirement for individualized risk assessment and could expose the insurer to unforeseen losses. Another incorrect approach is to apply a standardized underwriting checklist without considering the specific nuances of the construction project. While checklists can be useful tools, they should not replace a comprehensive risk evaluation. Over-reliance on a generic checklist can lead to overlooking critical, project-specific risks that are not explicitly covered by the standard questions, thereby failing to meet the regulatory standard for prudent underwriting. Furthermore, an incorrect approach would be to assume that the insured's stated risk mitigation efforts are sufficient without independent verification or seeking further clarification. This abdication of due diligence is ethically questionable and regulatorily unsound, as it places undue trust in the insured's self-assessment without the underwriter fulfilling their responsibility to independently evaluate the risk. This can lead to coverage gaps and potential disputes. The professional decision-making process for similar situations should involve a systematic approach. First, thoroughly understand the regulatory framework governing commercial liability insurance in the specified jurisdiction. Second, conduct a detailed risk assessment of the specific construction project, considering all relevant factors. Third, evaluate the effectiveness of the insured's risk management practices. Fourth, determine appropriate policy terms, conditions, exclusions, and pricing based on the risk assessment and regulatory requirements. Finally, document the underwriting decision-making process comprehensively to demonstrate compliance and provide a clear audit trail. Question 20. Research into the interpretation of exclusion clauses in commercial liability policies reveals a common scenario where a policyholder, a small manufacturing firm, submits a claim for damage resulting from a product recall. The policy contains an exclusion for loss arising from any recall or withdrawal of any product or any part thereof. The underwriter is considering applying this exclusion to deny the claim. What is the most appropriate course of action for the underwriter in this situation, considering the principles of fair claims handling and regulatory expectations. Option A. Deny the claim immediately based on the explicit wording of the exclusion clause, as the damage directly relates to a product recall. Option B. Investigate the specific circumstances of the recall, the nature of the damage claimed, and the precise wording and context of the exclusion clause to determine if it unambiguously applies to the loss incurred. Option C. Advise the policyholder that while the exclusion exists, the insurer may consider a partial payment as a gesture of goodwill, regardless of the exclusion's applicability. Option D. Interpret the exclusion clause in its broadest possible sense to ensure the insurer is not exposed to losses that were intended to be excluded, even if the claim has some merit. The correct answer is A. Deny the claim immediately based on the explicit wording of the exclusion clause, as the damage directly relates to a product recall. Explanation. This scenario presents a professional challenge because the underwriter must balance the insurer's need to manage risk and adhere to policy terms with the ethical obligation to act with integrity and fairness towards the insured. The core of the challenge lies in interpreting an exclusion clause that, while potentially valid, could lead to a significant financial burden for the insured if applied without thorough consideration of the context and the insurer's duty of utmost good faith. Careful judgment is required to ensure the exclusion is applied appropriately and not in a manner that could be perceived as opportunistic or unfair. The correct approach involves a thorough review of the policy wording, the specific circumstances of the claim, and relevant regulatory guidance on the interpretation of exclusion clauses. This approach prioritizes a fair and accurate application of the policy, ensuring that the exclusion is only invoked if it clearly and unambiguously applies to the situation, and that the insured has been adequately informed of its scope. This aligns with the principles of utmost good faith, which requires insurers to deal honestly and fairly with policyholders, and regulatory frameworks that often mandate clear and unambiguous policy language, especially for exclusions. An incorrect approach would be to immediately deny coverage based solely on the presence of the exclusion, without further investigation. This fails to uphold the duty of utmost good faith, and could be seen as a breach of contract if the exclusion is not demonstrably applicable. Another incorrect approach would be to interpret the exclusion in the broadest possible manner to maximize the insurer's benefit, even if a more reasonable interpretation would afford coverage. This demonstrates a lack of fairness and could violate regulatory principles that aim to protect consumers from unfair claims handling practices. A third incorrect approach would be to apply the exclusion without considering any potential ambiguities or the insured's reasonable expectations of coverage, especially if the policy wording is complex or could be interpreted in multiple ways. This overlooks the principle that exclusions should be construed narrowly against the insurer. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the policy contract, including all endorsements and exclusions. This should be followed by a detailed factual investigation of the claim. The underwriter must then critically assess whether the exclusion, as written, clearly and unambiguously applies to the established facts. If there is any ambiguity, or if the application of the exclusion would lead to an unfair outcome given the insured's reasonable expectations, the underwriter should consult with legal counsel or senior management and consider alternative interpretations that are consistent with regulatory requirements and ethical obligations. The ultimate decision should be well documented, transparent, and justifiable based on the policy terms and applicable regulations.